There is a moment in every Australian investor's journey that almost no one talks about. It is the stretch between your first $100,000 and your first $500,000. On paper, it sounds like a simple, linear jump. You save more, invest more, and repeat the process. But the truth is, the game completely changes between those two numbers, and most people get blindsided because nobody warns them about the shift. When you crossed that $100,000 mark, you probably felt incredibly proud. You sacrificed daily coffees, packed your lunches, picked up side hustles, and watched every single dollar. Hitting that first six-figure milestone takes pure willpower. It is slow, it is grinding, and it is easily the hardest stage of wealth building in Australia. But here's what changes the second you push past it. Your money finally starts pulling its own weight. At $100,000 invested in a diversified portfolio, earning around 8% a year, you're generating roughly $8,000 annually without lifting a finger. By the time you hit $500,000, that exact same 8% return becomes $40,000 a year. Suddenly, the market is doing more heavy lifting for your wealth than your personal savings rate ever could. To put that in perspective, a full-time worker on the median Australian wage earns roughly $75,000 before tax. A $500,000 portfolio compounding at 8% generates more than half of that income completely passively every single year. This is the structural shift that catches people off guard. From $0 to $100,000, your personal contributions drive your growth. From $100,000 to $500,000, the market starts taking over. From $500,000 onward, compounding becomes your main engine. Your day job stops being the hero. Your portfolio does. However, this transition brings new problems that most Aussies simply are not ready for, and the first major hurdle is tax. At $100,000 invested, capital gains and dividends barely move the needle on your tax return. At $500,000, they start pushing you into significantly higher tax brackets. If you're earning a decent salary plus pulling $20,000 or $30,000 in distributions from ETFs and shares, the ATO becomes your most aggressive business partner. That's why legal structure starts mattering a lot more than individual stock picks. This is the exact stage where serious Australian investors begin thinking well beyond their personal names. Family trusts, investment companies, and even insurance bonds become real, practical considerations once your portfolio crosses a few $100,000. A discretionary trust lets you stream investment income to lower taxed family members. A bucket company caps your tax at 25 or 30% on retained earnings, instead of your personal marginal rate, which could be as high as 47%, including the Medicare levy. Then there's superannuation. If you're a high-income earner, super becomes one of the most powerful wealth tools in the country. Concessional contributions are taxed at just 15% inside the super environment, compared to up to 47% outside of it. Even modest extra concessional contributions made consistently across a decade can add hundreds of thousands of dollars to your retirement balance once tax savings and compounding stack on top of each other. Let's talk about debt. At $100,000 invested, leverage feels incredibly scary. At $500,000, leverage becomes a strategic tool. This is where strategies like debt recycling enter the conversation. The idea is simple. You use the equity in your home loan to invest in income-producing assets, turning non-deductible mortgage debt into tax-deductible investment debt. For someone in the higher tax brackets, the tax saving alone can fund a massive part of the strategy. Done properly, debt recycling can shave years off a mortgage while building a serious investment portfolio at the exact same time. The next thing that changes is the portfolio itself. At $100,000, simplicity wins. One or two diversified ETFs, low fees, and regular contributions are all you need. At $500,000, concentration risk becomes real. If a massive chunk of your portfolio sits in a single Australian index fund, you're heavily exposed to just 4 big banks and 2 mining companies. Diversification at this level isn't about adding more funds for the sake of it. It's about making sure no single sector, country, or currency can sink your wealth. Many Aussie investors at this stage start broadening into international shares, listed property, infrastructure, and alternatives, because protecting what you've built becomes just as important as growing it. The path from $100,000 to $500,000 is rarely linear. It rewards patience, not perfection. The encouraging part is the timeline gets shorter with every step. Going from $100,000 to $200,000 typically takes about half as long as going from $0 to $100,000. By the time you're working from $400,000 up to $500,000, compounding alone does most of the work. Focus on getting past that first $100,000 as fast as humanly possible, because that's when the real momentum begins.